Welcome to the Daily Update. This is being prepared Friday, November 4th, where we'll look at the action in the market today and then see how things look for Monday, November 7th. And I'm sorry I'm a little bit late with posting the video. I like to post it much earlier than now, but there was just so much noise going on that I had to stop recording numerous times until things got quieter. So let's talk about what's happening. We're kind of in a mixed environment right now. We had the big disappointment earlier in the week with Chairperson Powell's speech that pretty much wiped out the idea that the Fed would raise interest rates a little bit less in December. And then Thursday, we're just kind of milling around, not really knowing what to do. Well, Friday turned out to be a positive day. So that's giving us kind of a mixed picture right now. So what are some things that we can say? First of all, right at the open, we had a higher open and we actually opened above R1. The employment situation report came out and it was taken as positive. Now, it could have just as easily been taken as negative. There were some different things in that report that the market could have fixated on and chose to go lower or higher or stay about the same. The futures were actually pretty strong during the night. And right after the report came down, they just went down very severely and then just came right back up. By the time we opened for the session, we opened above R1 at 37.48. Then we even went above R2 at 37.75. And then right after that, a whole lot of selling came in and took us down a little bit lower. But then we were able to recover back to above R2. Then as the day went on, selling came in again, took us down to the daily pivot at 37.23, which was just above the unchanged level, which acted as support. And then we bounced back up, got back up to almost R2. So we ended up being up 1.36% on the day on above average volume. The technicals are kind of mixed right now. They were more negative a couple of days ago because we lost that whole positive picture. Some of them are still working off being overbought, and now they're no longer overbought. But we're seeing just differences as we're going along here. And you'll notice that as I go through the charts. The markets continue to be really back now more confused about the inflation and interest rate picture because they felt like they kind of knew what was happening, but that was not confirmed by Chairperson Powell after the meeting on Wednesday. Of course, we have the geopolitical events, Russia, Ukraine, different things. I have Iran and Saudi Arabia listed here. Haven't really heard much out of that. So maybe that will calm down or maybe it could escalate. We've got earnings coming out with a vengeance right now. We may get some more Fed speak, but the important thing about any Fed speak is it needs to come from Chairperson Powell. Just another member saying something is not enough. It might help a little bit, but since he is the chairperson, that's what really counts. And then, of course, this coming week is the big week of the midterm election. Now, that may not impact the markets all that much, but it is what everybody's talking about currently, or at least the people that I talk to, it's what they're talking about. So what are some comments that we can make? The employment situation report was seen as positive, even after the futures were up most of the night. So I pretty much said that before. They took a bit of a dip and then came right back up after that. There's renewed speculation. This was kind of what gave some positive flair to Friday's session, that now they're saying China may relax their zero COVID policy, and how that influences the US is mainly the supply chain. If China's economy gets a little bit stronger, that might help a lot of the shipments that come from China. There's also another point that I'll make here in a moment. The dollar declined, so it was going down. That really gave stocks a lot of support, especially at the end of the session, as well as interest rates. They did decline. And then here's the other point where the Chinese stocks did really well on Friday, as well as those US stocks that have Chinese exposure. They had good days because of this speculation. So we have to be aware of that. There's nothing necessarily official about this, but that China may not be having as tight of restrictions as what they've been having. The VIX is still oversold. The VIX has been acting strange. When we had the big down day, the VIX didn't move. Well, when we had the up day, the VIX went down, and we continue to be oversold. And that's contrary, because when the VIX goes down, that means the market typically is going up. We still have a number of yield curves that are inverted, the 10 to the 5, the 10 to the 2, the 10 to the 3-month, as well as the 30 to the 5. And I have the 10 to the 3-month in gold just because it was the longest holdout. And a lot of economists use that as their determining factor for, okay, now we can see where the economy is going to be weak in the future, if not go into a recession if we're not already in one. Sentiment is shifted more back to neutral. It went up slightly in Friday's session, but we're still kind of in that neutral area. And then we had the employment situation report, and I'll deal with that on the next slide. Our trend, we've switched back to neutral because we've dropped below 20 now. We may not be there for a while, or it may be an extended period of time. We just don't know right now. With the markets kind of confused and giving us real mixed signals right now, it might stay there for a little bit, but it is weakening since it's dropping below 20, and the red line is on top. So if you want to default to a trend, it would be to a negative trend. Our bias, I've changed back to mixed because we had some really good up days, then some strong down days. And then even though Friday was an up day, we're just kind of bouncing around right now. And I've also kept our momentum more at mixed. So here's the employment situation report. The non-farm payrolls, this is the headline number that comes out. It came out at 261,000. That was more than expected at 220,000. The last time we got this report, it was at 315,000. So it is coming down, but it was stronger than expected. The markets could have tanked on this news since it was strong, and that means more interest rate hikes. Then we had the non-farm private payrolls. They also came in stronger than expected at 233,000 versus the expected 225,000. And they're also coming down, where last time we had 319,000. And then the average hourly earnings, this is usually what the market really watches, and it could have tanked on this because it came in at 0.4%, where they expected it to be up 0.3%. Last time it was 0.3%. That means more earnings, which means more potential inflation, but the market didn't do that. The unemployment rate, which a lot of people in the markets anyway don't really pay attention to because this number can really be manipulated, it actually rose to 3.7% from the expected 3.6%, and last time it was at 3.5%. And the average work week was 34.5. That came in as expected. But overall, the market said, okay, well, it could have been worse, so let's take this market higher. But it was still a very choppy day nonetheless. There's really nothing to update here. If you watch the videos consistently, there was no game Friday evening. So Houston still leads Philadelphia 3-2, but by the time you watch this, the World Series just might be over. If Houston wins another game, that'll be it. All right, let's go back and talk about the day's session, where I'm saying we're more neutral, but we're kind of at the lower end of the positive side of things. And then you can see how the historical chart, we came back down when we really had that decline, and then we're starting to recover here. We had the active asset managers. They're showing some improvement. Now, remember, this report is a week old, so it's not figuring in all of the roller coaster ride that we went through in the past week, but it is showing some improvement. And then the RightX bear bull ratio. This is also a couple of days behind, where people were really starting to get out of the bearish funds and getting back into the bullish funds. Well, they're getting kicked around quite a bit as well. And then every week we get the individual investors. How do they feel? Well, after being extreme pessimistic, they're extreme negative for a while, they are showing some improvement as well. But again, this does not necessarily reflect the last week of all the roller coaster we went through. Here's some Isabel net charts, and I have a few extra because I didn't do a full-blown video for Friday's session. This is just showing the Goldman Sachs version of what they think GDP will be for the third quarter, 2.6%, and then the forecasting out. The interesting takeaway from this is that they're predicting positive GDP going forward. So they're not necessarily looking at a recession according to this chart. Then we have the Fed funds. That's the bottom, and they've really been rising quickly. Well, as the Fed funds rate goes up, earnings are coming down, or at least the earnings growth rate is really coming down, and that's why we're seeing stocks under pressure. Another chart just shows the risk appetite. We're just about in the middle. People aren't really willing to jump into the risky things, and they're not really willing to get into the non-risky things right now because they're just waiting to see what will happen from here. And then here's the ISM manufacturing. That's the important report that came out earlier in the week. That's the green line and how it's really been going down. And then match that with CPI, or the inflation rate, which really topped out. And it's still very high, but it has been coming down. Again, these lines tend to not get very far apart from each other. Well, right now, they're quite far apart. So does that mean that manufacturing is going to pick back up, or inflation is going to come down? We'll have to see, or a combination of the two. Then this contradicts a chart that I showed in the last full-blown video. This is showing how corporate buybacks are really increasing, but it is decelerating a little bit right now, where the other chart just said people aren't buying back any of their own corporate stock currently. So we're getting some conflicting information there. This is just, the headline is more the important part here. Recessions are painful for stocks and hardly discounted in advance. It seems like when recessions hit, it's like it catches everybody off guard. Well, the stock market likes to look forward, but they're not really good about doing that when a recession happens. And this suggests that there's plenty of room for more downside for the S&P. And this just goes back and shows the different recessions that we've had and how much we did decline during those times. All right, then this is another trend that we've been seeing as the mortgage rates are really starting to come down as far as the housing market. That's the dark blue line in here. And then you can compare it to other years going back to 2013. Also, then historically, hiking cycles have been longer. That's one of the things that's really worrying the market, is that the Fed is really raising interest rates quickly. And over here, the second one over where it says US, this is just the median. Usually it takes longer, up to 25 months or a little over 2 years for the whole cycle to happen. Well, the current cycle, we haven't even started for a year yet, and they've really raised rates quickly in that period of time. And that's what a lot of people are worried about as far as, is it going to really harm the economy? Then the number of months when the S&P is either up or down at least 7.5%. Well, we've been bouncing all over in 2022. There are 5 times. It doesn't say positive or negative. It's just talking about the moves in general. Then this says value is still 32% underweight when you compare it to growth. Some folks have been getting out of the value stocks and getting back into growth stocks, thinking that we're going to be more positive going forward. And this just suggests that most people are still in growth stocks, or they're underweighted when compared with value stocks. The value stocks are underweighted. Okay, I'm really messing this up. Value stocks are underweighted to growth stocks. All right. Then this just, every chart we look at, there was one chart earlier that said this is the worst bond market we've had since 1788, which was when the Constitution was ratified. Well, this talks about this is the lowest that they've been in 50 years. So any way you look at it, whether you go back a long way or not very long, we're down with bond prices. And if you've been investing in bonds the last year or so, you're pretty disappointed with things right now. Then this just looks at the used car prices and how they were just really going up. That's the light blue line. Well, as the S&P has been coming down, so has the value or the prices for used vehicles. And then the fusion index of every possible yield curve inversion. So when you take all the different kinds of yield curves that are out there, and I just show a few of them, This, where the blue circle is here, this just shows that we're up close to 70% of those yield curves being inverted. And then other times, if you know your history, when we really spiked up, that usually signaled some real economic weakness or a recession. This is another chart suggesting that the terminal rate, when the Fed's finally going to top out, is somewhere between 5.5 and 5.75. That's much higher than what the markets had been anticipating before rates end up starting to come down. Then this is just the behavior of the S&P after or during recent Fed events, how they act before, then after, right after everything happens, and then during the press conference. They're all over the place. So it's really hard to get, and they talk about the different Fed meetings and how the market ended up reacting. So, I mean, take your pick. The kind of the rust colored line here, this is how things reacted in this past week. And it wasn't very positive. All right. Then here we have the GDP Now forecast. That's way up here. That's anywhere from 3 to a little bit under 3% to almost 3.5%. That's what they're forecasting. Well, when you look at some other forecasts, the top of the range is just under 2%, all the way down to being slightly under 1% of GDP growth. So they're all over the map with what they think is going to happen, the economists think, going forward. Then inflation is a monetary phenomenon. You think? Okay. When inflation goes up, then this is the M2 money supply, and they've advanced it 9 months to show, okay, so if they're going to start taking money out of the system, then that could produce some inflation, or that could weaken inflation, but it could increase the value of the dollar. But there's so much out there, all the stimulus, all the liquidity, all of the money that's out there. We'll have to see if it really comes down as quick as what it's been coming down lately. Then we have, as global inflation and inflation expectations remain stubbornly high. This light blue line is world inflation. My goodness, it's really going up. And then these are inflation expectations. They're still, well, they're getting down to about where we were at the bottom in the financial crisis. So we're seeing a real difference in these forecasts. Also, let's talk about what happened during the day. We were up across the board. Growth did pretty good with the large cap, but underperformed with the mid cap and small caps. The VIX continues to decline. Even with the down days that we saw, the VIX is still really going down. And the VIX of the VIX is also continuing to go down and giving some very low readings as far as the volatility of the VIX. And then here's, because we're seeing the VIX really dropping, the RSI is in oversold territory, which could produce some real problems for the market, because generally as the VIX is going up, that means stocks are going down. And then the Ulcer Index, which also measures fear, it's kind of about where sentiment is at right now. Underneath the moving average, fear is increasing slightly, but not necessarily extreme. We're down 21.75% from the all-time high. And the equity put call ratio, it really spiked up earlier in the week, only to come back down. Well, it climbed up a little bit in Friday's session. And then here's the 5-day moving average. We're still working off of this spike here, which is an extreme reading, which sometimes marks a bottom, but we'll have to see. Are we going to go up and generate a new signal? As far as support and resistance, and these have been posted on the YouTube community tab, here are the pivot levels for Monday's session. And here's the daily chart where we closed right at about the pivot point. So we're kind of at a tipping point. Above the pivot point would be more positive. Below the pivot point is more negative. It's slightly more negative now because we did lose the 50-period moving average. And then you can see at the bottom where we had an increase in volume. The short-term fib levels were still back underneath these two overlapping short-term fib levels currently, where we had got above those and then fell back below them. Well, they could provide overhead resistance. And then the longer-term look here, where we broke another two fib levels that were on top of each other, And this could also provide overhead resistance at about 38.24. But on a longer term basis, we broke down below the 38.2% retracement. That's negative, but we're still above the 200-week moving average. And that could be really important. If we do come down and fall below that, are we going to hold at the 50%? That held before. If we come down and do this again, is it going to hold the next time? We're getting a little bit more to the negative side of our trend channel. And then as far as the sectors, we had materials, financials, and tech. With industrials, they were up. In fact, all the sectors ended up being up. The ones that weren't up as much were utilities and healthcare. And then looking at our technical analysis charts, the energy and industry and healthcare, they're all into the 90s. So they're having a good looking chart right now, where communication, my goodness, 2.6. I've often wondered, do they have negative numbers for these things? But pretty much when you get to 0, that's about it. Here is energy, which is up almost 60% since the Dow set its all-time high. Utilities have now gone back into second place, followed by healthcare, where you have communication, discretionary, tech, and real estate really, really down since the all-time high. The pink column right here is the S&P 500. How have the different indexes performed since that all-time high? We're down across the board. Technical alerts, we had some negative ones with the NASDAQ going below 10.5, 10.4, then back above 10.4, then back above 10.5. Then I got down to 10.3. My gosh, crazy, seasick day. The communications sector set a 2-year low. No, they have the worst looking chart, so not surprising there. And then oil is starting to go back up. The people running for re-election are probably not going to like that this coming week if gas prices continue to go up. Then the Dow is still looking okay as far as our chart overall. It's into the 90s. Then in second place are the mid caps at 80.1, and then small caps are at 77.7, and the S&P, which is just not looking all that healthy right now, at 41.8. And then in last place are the Qs, which represent the NASDAQ 100 at 8.7. So we did gap higher in Friday's session. We went above R1, made it all the way up through R2. Then we immediately came back down. Then we shot up above R2, then came all the way down to the pivot and to the unchanged level. Actually went a little bit negative there for a while. But then later in the day, as interest rates were going down and the dollar was going down, stocks felt the support from that and continued to go back up and almost got back to the R2 level. And this also has been posted on the YouTube community tab. This is just the different pivot points that apply for the whole month. As far as our trend, we are dropping below 20 now. We're at 19.48. The red line is on top. So we're in a non-trending environment with a negative bias. Our rune is pretty much flat. It still has buyers doing okay, where sellers are decreasing, but overall, we're not seeing a real change. Breadth did show some improvement. We didn't have a real strong upthrust day. There was so much waving going on, but we did see a bit of an advance based on price and volume. We saw a bit of an improvement with the advanced decline ratio. It came down to the 0 level here and is bouncing back up. And new highs, new lows, they're hanging in there. When we were up in that part of the day, we did see an expansion of new highs, but when we were going down, we saw an increase in new lows. But overall, we're going up with the 5 period, and we're pretty much flat now with the 10 period. Accumulation distribution is still negative, but showing some improvement. Short-term charts, we're back down to the 20 period moving average now. The important one is the red line, and the fact that we closed a little bit above that, that's important. But we're right at the blue line, which is the exponential moving average. And here's our rainbow, just showing how we were starting to come up out of that, only to come right back down. Stochc RSI, after being extreme negative, is starting to look a little more positive. We're turning back up with the Williams percent R. The force index is still negative, but showing some improvement. The Swinland Trading Oscillator, this is negative. We're dropping below zero with both price and volume. McClellan Oscillator, after giving us an extreme reading, did work that off and is showing some improvement. We're still above zero, so that'll help the summation index. With our moving average study, after being extreme positive, come back down, saw some improvement, showing some improvement with the 50 and with the 200-day exponential moving averages. Stochastics, which had been extreme positive, wore that off, showing some improvement, still declining in the intermediate term, and still turning over in the longer term after being extreme positive. Now, intermediate term, this is our 50-period moving average. We're still below that. We lost it earlier in the week. Can we get that back? That's an important moving average. And here's our moving average tree, just to show all the different ones and how they've been behaving. The Sean trend meter is pretty much flat, but looking more negative. The PMO is still positive, but showing some weakness, as well as based on price and volume. The PMOs that are rising after being extreme positive worked that off, showing some improvement. The buy signals are still extreme positive and declining, and we're showing a little bit of an advance with the PMOs that are above zero. Chaikin Oscillator, after being more negative, is showing a little bit of improvement. Chaikin Money Flow also showing some improvement. We saw not real big pickup in volume. We're just kind of about at average right now. The Vortex, even though it's showing some weakness, continues to have the green line on top, so that's positive. The summation index is still advancing, although it's below zero based on price, and it's starting to decline, but still above zero based on volume. This kind of typifies where we're at right now. Showing some improvement, but still negative, or starting to show weakness, but still positive. Yeah. And our oscillators, they're still all positive, but they're starting to roll over. So if we see more downside, these oscillators could turn negative. The BPI, really just a little tick of a blue bar, or green right in there. So that's holding up okay for right now. Ease of movement was also pretty much flat. Ultimate Oscillator showed a little bit of improvement. Money Flow Index was pretty much flat after declining. The TTM squeeze, when these bars turn darker, that means it's more negative and they're starting to go down. And the balance of power, this is a little more positive. We're still above this dashed line here, but we are declining. The CMB composite has now generated a sell signal. When it crosses above the first moving average, that's sell signal number one. And when it goes below the green one, that's a confirmation signal, and it is currently declining. And then we had been able to get back above this anchored moving average going back to the COVID low. Well, we lost that after the Fed announcement, and we're coming down to these 50-period triple and double moving averages, and we're just slightly above them. So we're kind of mixed right now. Our charts, we're looking at more negative with the Heiken Ashi. We're still positive with the Kegi, but we're looking more negative with the Renko because it has a red box. And three-line break is also looking more negative. Nothing has changed on the point and figure chart. Our trading systems, we are negative with the Elder's Impulse for the S&P and for the SPY. But we're also negative for the SAR. That triggered after after Thursday's session. So again, that's more negative. And then we're back to more of a neutral to negative signal with the go, no-go system. After generating a go, it immediately said, no, you don't want to do that. No go, no go. All right, then longer term, seeing a little bit of improvement with our 50, 150, and 200-day moving averages. But longer term, we're still turning up with the 200-day rate of change. Special case, still trying to show some improvement. But 250, if you go back, we're starting to see some more weakness. Diamonds, which is the Dow, that's still in neutral territory. And we came right up to the 200-day moving average and then came back down from that. And the Dow is still looking the best right now as far as on a technical analysis basis. The Qs are negative based on the NASDAQ 100, and they're still above this support level. So that can be seen as positive, but we're still in a pretty significant downtrend. And the Vixen, which is just giving us all kinds of crazy information, it continues to decline as well. But we did have an up day. But even when we had these really big down days, it barely moved. The NASDAQ also looking more negative, but still above S1. And the mid caps still above their 50-period moving average and still above the pivot. So they're holding up. That's why this chart's in second place. And then the Wilshire is slightly above the pivot point, but below the 50-period moving average. Then the dollar got hit pretty hard in Friday's session, and that gave a lot of support to stocks, but the dollar continues to be in an overall uptrend. When you compare the S&P to the dollar, they're having a tendency to kind of be more neutral now. They had been going in opposite directions. Well, this is starting to wear off and come back up into a neutral reading. Gold had a really strong update, up over 3%. Okay, are we going to the moon now with gold? We did get back above the 50-period moving average, but we're still in an overall downtrend. Silver was up, my goodness, 7 1/3%, but still in an overall downtrend and still below the 200-day moving average. Oil is now back above 90 at 92.61. And S&P and the oil, they're pretty much neutral right now and having a slight tendency to go in opposite directions. Bonds were virtually unchanged in Friday's session with our ETF, and slightly up with our world bond index. And looking at our yield curves, the same as what I've been talking about. The 10 to the 5 is inverted. The 30 to the 5 is inverted. The 10 to the 2 is inverted. And the last holdout was the 10 to the 3 month, and it remains inverted. Here's just a look at the 10-year yield. We're at 4.156% right now. And here's another chart of the 10-year yield. After really spiking up, came down. It actually gave some support in its decline. The 30-year is at 4.27%, and showing that the yield on the 2-year is still giving you the best, even though it declined. And we're seeing these lines just cross all back and forth over each other. That just talks about a real confused market and a real confused economy currently. Our correlation, stocks to bonds, getting back to more of a neutral reading, but having a slight tendency to go in the same direction. The S&P to the 2-year still having a fairly strong tendency to go in opposite directions. And with the S&P to the 10-year, it's coming back up slightly, but they still have a tendency to go in the opposite direction. And tech to the 10-year, we're back into the neutral reading. Our scenarios. After really spiking up based on price, we've come back down and saw a little, this really didn't change in Friday's session. So we're still working off of this extreme negative reading, but we have to see follow through with price, and we're just not seeing that. This didn't change all that much either. The percent of stocks in the S&P that are above their 200-day simple moving average, after giving us 2 extreme readings, is showing some improvement. Stocks above their 50, this moves a little bit more, and it showed some improvement with the S&P as well as with the mid caps and the small caps. The 10-day average of the highs and lows showing a little bit of improvement. That's a little slower measurement, so it hasn't been declining. And then looking at the broad market with the 5-period moving average of the highs and lows, it almost got back up to the 0 level, but then showing a little bit of a decline. And then the longer look at our equity put call ratio going back 5 periods, we're still working off of this extreme reading, but we're still pretty high right now. Even though it came down slightly, we could go up and potentially anyway and generate another signal. The small cap index is still above the pivot level and above the 50-period moving average, so that's holding up a little better. And small caps have been outperforming the S&P, which is giving a little bit of support. We're seeing a spike in the red chart here, which sometimes can give some support to the S&P, which is the blue chart. But our sector rotation, just not really happening right now. The Qs to the S&P declining and setting new lows. Discretionary to the S&P also declining. Large cap growth to large cap value also declining. Then large, mid, and small caps continue to show weakness, even on an up day. And the utilities ratio is also starting to come back down. This had been giving some support to the S&P, but now with it coming back down, that could put some more pressure on the S&P. And we don't know if the 2-year yield, it could just keep going up and up and up. So we wait for this to spike and then start coming back down. Well, it hasn't started to come down yet. The staples were up over 1%. They're still in an overall downtrend. But when you compare it to the S&P, we've now taken out these other spikes. So now we have another spike to deal with. These have all been negated currently. You can see how choppy they are, where if you go back and look at this at other times, we didn't necessarily see all this. This just shows a really confused market. Our Copic curve, we're probably going to lose that pretty soon, but we're still going back to the signal. But our parade got rained on. So things were looking like they were getting a lot better, only to come back down. And we are losing the Pring bottom fisher. And I just wanted to show this chart. So probably in the next video, I won't even include this again. So what's our outlook for Monday? The technicals, they're mixed. They're still mixed. We have consumer credit coming out on Monday. And then we have Russia, Ukraine, that whole situation, inflation and interest rates. Probably the big news topic anyway is going to be the election. We'll have to keep an eye on Iran and Saudi Arabia, as well as different things going on in China. But it'll probably be the World Series, any Fed speak, and the election. Of course, now watch it be something else completely different. So we can't really go with the up scenario or the down scenario because really, and I meant to change that to gold color there. We're really in a sideways environment right now because the ADX is below 20, but we default to the negative because the red line is on top. So our conclusion, the S&P, it's mixed right now. Short-term mixed, intermediate term negative to mixed. Long-term is still negative overall. So thank you. Have a wonderful weekend. And I will prepare the daily brief. I'll also prepare the weekly video as well as the intermarket analysis video.